How's it going? Mark Anderson here, construction worker turned 0DT hedge fund manager, and we have Connor back here, and he found some stuff. So first thing I kind of wanted to go through was, I know we talked about expected value equation last week, which if Connor, you could go over basically what was your thought in regards to that expected value equation. This is the back test that Connor came to. He had a 1 to 3 risk reward. So if you could kind of put in your own words what you learned about that equation and kind of how you went about testing that in your back testing as well.
Yeah, so basically what I learned from this equation, two things was when I'm around
explain to me what the equation is first as well. So
the equation is your average winner minus your average loser times times your win rate. And as I was plugging these numbers in, I started realizing that you need to do ratios. And so I played with the 2-to-1 ratio and I played with the 3-to-1 ratio. And I came to find out that the 3-to-1 ratio and the 1-to-1 ratio, as far as this specific trade, performed the best. And what that made me realize is, me and Mark were kind of just laughing about this, but when I say if I had a average win and an average loss that were pretty close together, I needed a lower win rate to be able to have, a good expected value. But for me, to have a higher expected value, I needed to be able to, have it lose a little bit of money, but that is going to raise my expected value as well. So that's kind of what I've learned from this on the conceptual standpoint.
And the thing that I kind of want to highlight here, Connor's obviously knew this and we're working through it, but you can see here that all three of these are a 3-to-1 risk to reward ratio. So, but you can see that the premium capture drops off, even though our average winners may go up or go down. So the key I wanted to kind of highlight here is when we're looking at what we're doing, instead of adding 4 or 5 different filters on things and trying to just muscle our way up to like a 90% win rate, what we want to do is we want to see that there's a curve of managing risk. So clearly, when we're looking at 2-to-1, it kind of works. When we're looking at 3-to-1, it kind of works, but it seems that this 3-to-1 and this 1-to-1 seem to work. So up and down the curve, this entry time looks quite good. We can see that there's positive expected value, but we also kind of see that this curve bends over at a certain point, and we don't want to be, putting on these trades that kind of bend over in the wrong area. We want to kind of stay in the good stuff. And we're doing this through showing that expected value rather than anything else. The other thing about this, and this is when we think about the parts of the portfolio. So Connor right now is working with a 30 grand account. He's going to go to a 50 grand account and then a 100 grand account as we progress through here. So you could look at this and you say, hey, this trade right here has a 9.9% premium capture. Like, we want to do this all day. And this trade has a 4.4% premium capture. Okay. So a lot of people would just instantly say this, but the point I want to look at this is when we're using a 20% profit take and a 60% stop loss, if we go ahead and look at the trade log and we filter into winners, you can see that, we're exiting at 11:30, 11:13, 11:40. So if we were to choose this trade, even though it doesn't have as high of a PCR, we're going to get our buying power back at noon so we could use it twice. And the key concept with that I really want to highlight is, if we can reuse our buying power twice, we have twice the ability to potentially make money. So we're not just looking at what's most optimal in isolation. And also, if we're getting out at 11:30, if there's a big move at 2:30 that stops out or all in it open or other power hour trades that we have or calendars, this trade won't be exposed. So we can derive value in a trade that is not as profitable if it helps us better manage our risk. So that's another concept and why I kind of guided Connor to choose this one in particular. The other thing I wanted to show, to kind of show this outside of back test, is This is an Excel sheet that's basically an expectancy simulator. So if we were to plug in here, we know, like, let's say our projected win rate in this test is 82%. Our profit target is 20%. And then our stop loss is 60%. So this is basically the confines of our trade. This basically will randomly show, how much money we can make over the long term. So this just runs through 100 trades of what's going on. We can increase this to 500 trades and, show that it gets a little smoother. And then we can also bring this down to 10 trades, which may be over the course of 2 or 3 weeks. And we could see it's rather jagged return. So I had Connor play with this too, but looking at when I change the number of trades, Connor, what does this tell you about our path to profitability? And what does that curve look like when I go from 10 trades to 50 to, 100? You see how the lines change here? So yeah. I guess I'd kind of say, like, what did you learn from playing with this about expected value outside of just testing?
Just from looking at those curves, is the more trades, the better on this. I mean, what you've just explained previously before as well. Like if I'm able to use that for buying power twice, that's better for me. If I can trade more times and then I can make more money correctly.
Correct. So that's kind of the thing. And the concept I want to show here is, okay, so if we go back to this, we have a 1-to-1 risk to reward. And with a 50%-ish win rate, since it's a coin flip, we're going to have a lot more ups and down swings. So if I'm going to this expectancy simulator and I'm saying our projected win rate is, let's say, 55%, our profit target is 100%, and our stop loss is 100%. So over 25 trades, you can see it's quite volatile, which this would probably be a month and a half. And let's say over 150 trades, this is a year, it becomes pretty consistent. But if we were to change this to an 80% win rate, and then we go to our profit take of 20% and our profit take of 60 and our stop loss of 60%, you can see that it's actually a little more consistent looking almost. Yeah. So even though our losses may be a little bigger, it goes up and to the right, a little more certainty with higher occurrences. But the higher our win rate is, the less we should deviate from our expected return, or the, that 45-degree angle of our return. And also the higher the occurrences we can make, the less the percent is going to work. So then
basically, I just have a quick question. Basically, by looking at these two, and it makes sense when you look at it mathematically, like, would I rather, win at 80%? Would I rather win at 50%? And looking at both of those, you're looking at, are you basically saying that, like, in real life, that 80% or 75% win rate is going to perform a lot better than that 51, even though it says, like, the P&L and all that on the 50 was like 34,000 and the P&L on the 75 was like 15,000. It's going to be a lot closer to that actual P&L on the 75% one than it is going to be on the 50%.
So the kind of concept here is that they both have a benefit to them.
Yeah.
The question is, we're just selecting the one that we think has the most benefit. So we can have diversity through time, which we're getting diversity through time here because this is a 1045 entry and all in it open is 932 entry. So we already got diversity of time. Then we can get diversity through risk to reward. So this has a 1-to-3 risk to reward, which is similar to all in it open. And then this has a 1-to-1 risk to reward, which gives us diversity in that fact. And then we could also have diversity with basically time exposure. So if this trade roughly lives for an hour and all in it open goes to expiration, it's only going to be 1/7 as correlated for that hour on the profit days. Makes sense. This trade is going to be just as exposed all the day. So
you're just looking at a portfolio, not just one trade in itself.
Yeah, one of them is not better than the other, and they each provide different benefits to our portfolio comparatively to basically one another because we're matching this with all net open and it still has the VIX filter on it. However, the other concept I want to show is when we looked at this expected value simulator, we can see there's 100 trades and then 1,000 trades. It becomes much more consistent. So if we can reuse the buying power, so each of these use the same buying power, but if we can make 200 occurrences on this versus 100 occurrences on this, because let's say we reuse the buying power at 3 p.m. or something because we're always out by 11, all of a sudden, even though you make half as much money on this trade, we get diversity. And since we make twice as many trades, not only is that P&L going to be a little more consistent because we make more occurrences, but the fact that it has a higher win rate means it's going to deviate less over that period of time. And since we can reuse the buying power, it could be a benefit to a small portfolio like yours. So
makes perfect sense.
Yeah, this is kind of what Connor had come up with in regards to it. It looks pretty good. It's been profitable all years. It hasn't been the best this year. It probably performs a little bit better in higher vol, but it's also nice to see a trade that in 2022, when everything was really, really good, it actually wasn't that much better than this year. And this year's been a tougher year. So this is a very interesting trade because during the best year for all of our other trades that we often struggle to find profit this year, it's been profitable this year. So, the main key here is that we're understanding how each of these fit into our portfolio iteratively. And then we're working with what we got, which is kind of like a 30 grand account and how these fit in. So the main part here is that we can have a trade that doesn't perform as well as our all net open or a calendar or Connor's curve fit thing. But since we have that small edge that we can run twice a day, almost every day, that edge over time compounds to be much larger. So we could have a worse part that makes a larger sum of the whole. And the other thing, if we go back to this screen, and Connor kind of brought this up too, is it's like, we are not a giant hedge fund in Connor's portfolio. It's like, we're not Alabama or Ohio State or Oregon. It's like, we're just trying to go to a bowl game. So instead of having this massive win rate of, 75% or 90% and trying to change this to like 10-1 or whatever, because we're risking it all to try to go to the national championship, nothing's wrong with being 5-5 and going to a bowl game, or, going 3-1 and going to a bowl game also. So by losing more, we can make more money as opposed to having a 10-1 risk to reward that makes us feel good because we win every day. So this kind of shows that managing your risk is a more important skill than kind of taking risk, which is what I would say was we're risk managers first and capital allocators second. And hint, hint, anyone that owns Bitcoin or Tesla, maybe it's time to think about managing your risk instead of thinking of how much more money you can make, especially at the end of year when you could, if you have any tax burden, you could offset or whatever. But never beside the fact, we're playing the math. And I guess my question is, what are kind of your three main takeaways from this, Connor? And how are you going to think about implementing that with your portfolio construction or how you back test in the future?
First and foremost, it's my big one was understanding that this is just for me personally.
And also when we do this, like psychologically, always state it in the positive tense because we can never build on failures. So the more positive we are, so it's like, even though you may have screwed up on back testing, you could be like, I learned a new way how to back test properly rather than I'm not going to screw up. And then it just mentally like gets the feedback loop going more so that we're going to be able to continue to move forward. It's like your kid, you're not going to be like, you got to learn how to walk,
Well, I learned to use the stop loss and the profit takes as ratios. Like a 3-to-1 ratio is a 2-to-1 ratio. Because when I first got into it, I was just throwing a bunch of numbers in, like 175, 100, and just seeing what happened. Let's do it as a mathematical equation, a 3-to-1 or a 2-to-1 or a 1-to-1, and see how that plays out. And look at the capture rate. Secondly, and see what premium are you capturing, and that's going to determine which one. I'm not going to say better because, like you said, which one
works for you. Yeah,
which one works for you. And then thirdly, just understanding that, when you're that 5-5 team or that 7-3 team, either one can work better, but they work differently.
Yeah. There's money to be made being 5-5.
Yeah, there's money to be made being 5-5. Yeah, it kind of threw me. It definitely brought that debate up in my mind. Like, 75% looks good, but when you're 5-5 and you're a good premium capture, it's still a good trade.
Yeah, I think we need to be 6-5 to go to a bowl, so maybe we'll call it that. But yeah, so I think the next step we could do here is, now that you have a little bit better understanding of this, freestyle a little bit with this. So maybe we could go 25 wide and it would work, or maybe you could collect $6 and $4 on the put and the call, or maybe going 100 wide.
A little bit more in the money, out of the money a little bit more.
Yeah, see what that kind of looks like. Maybe you could say, hey, we're just going to hold this for an hour and see what it looks like. But we'll get a little more intricate with what that is. Like I said, you can program this in Trade Steward, and we'll kind of go over next time, and then we'll have the real data that we will show with everyone. But we're just going to rip it for a month. So I'm ready with that. Still have a few more minutes. If you have any more particular questions for me, though, Connor?
Yeah. So basically, just building off of this. Now what I would go on, since now we have two options for our stop loss and our profit take. Now I can start playing with, the volatility. I can start playing with some of those filters, or in the money, out of the money, and just kind of the timing, like what we did before in the on the open weekend.
Yeah. And the thing here too is, I don't want it to be finding the highest PCR. I want you to be like, hey, this is at 1045 and it has a 4.5% premium capture. But if we run this at 230, it also has a 4.5% premium capture, and 230 is going to be much more uncorrelated from 932 all in open. So if we compared 4.5% premium capture at 230 versus 4.5 premium capture at 1045, the 230 is better because it's going to be more uncorrelated. So that's what I more mean by playing with it. Or it's like, if we could get 4% premium capture instead of 4.5, but we're 25 wide instead of 50, we're using half the buying power for, a 0.25% less profit. So again, that could be better. And
a more efficient trade. How can we be more efficient?
It doesn't necessarily be more efficient. It needs to be more efficient for your portfolio, or it could even be less efficient or just as efficient, as long as it fits in your portfolio. So I'm not really looking for you to put a filter on it, like that Monday curve fit one, to make it better. I'm more looking for you to be like, hey, even though this is same or worse, it provides more diversification because it's later in the day, it's a tighter width, it doesn't have the VIX filter on it. You know what I'm saying? That would be a huge benefit. So that is more what I'm looking for, is you're thinking dynamically of, hey, how does this help us in our portfolio? Not just we're looking at a singular backtest, because the whole edge is making a portfolio of uncorrelated strategies that basically lead to profit. And this is kind of called the dragnet theory. Like when you fish, you drag a net on the bottom. You're trying to get blue crab, but if you get shrimp, you can also make money off that. And if you get clams, you can also make money off that. And maybe if the clams are out competing the shrimp, the clam will make money when the shrimp isn't. So we just want to make sure we have that diversified thing, rather than just figuring out what's the best bait to get as many crabs as humanly possible.
That makes perfect sense. Then that kind of, I know you got to hop, but that makes me understand the portfolio, because that was going to be one of my big questions I was going to ask later on. But how you develop a portfolio, and it's just making it more diverse.
We're working on it. I'm hoping by guiding you through these trades and us running actual data on it, 3 months from now, when you're like, okay, I'm ready to make a portfolio, we can just be like, you're done. You're like, it's already there. You know what I'm saying? That's kind of, I'm guiding you very easily in that path.
It's off of me, right?
Yeah. Okay, we'll call it there. Appreciate it, Connor, and we will see you guys. Have any questions, drop in the comments.